welcome to everybody. I'm Michael Haliassos. I'm director of the CEPR network on household finance, and on behalf of the network, I would like to welcome everybody. First of all, our distinguished speakers for today, but also all the members of audience that are watching us from different parts of the world and actually in through different media as well. For the CEPR network on household finance, the collaboration with the Think Forward initiative is a very natural direction. The Think Forward initiative has as its aim to empower households to improve their financial behavior. We study household financial behavior, and we have been doing this for many years. TFI supports financially our conferences, our activities. It supports financially the PhD student paper prize. So it helps us encourage research in household finance among young people. But in terms of the direction of research, it adds a very interesting dimension, which is that it encourages academic researchers to think about an extra step of how to use the findings of the research to influence the financial behavior of households. So that's a very important step. And we assist TFI in evaluating research proposals and in funding projects which are academic and end up in very good journal publications, but at the same time have this application, this extra dimension. So at this point, I would like to introduce Stefan van Woelderen from the Think Forward initiative, who is going to say a few words on the initiative itself before we give the floor or the screen to Laurent Calvet, who will introduce the topic for today, finance and inequality, and our distinguished speakers. So, Stefan.
Thank you, Michael, and good evening, afternoon, or morning. Good morning, everyone. Also, I welcome you all to this CEPR-TFI event about finance and inequality. So as Michael said, my name is Stefan van Woelderen. I'm a principal economist at the Global Sustainability Department of ING, a large global bank. And I'm also the research hub lead of the Think Forward initiative, or in short, TFI. I'll be quite concise in describing what some TFI activities are, and especially what TFI does on the topic of this webinar. TFI is about helping people make better financial decisions. It's an inclusive partnership between ING, CEPR, and others, which is founded on the belief that society is better off when people make better financial decisions. And that's why we fund research and innovation, as Michael just explained. And we do fund it because it's research and innovation that intends to help those who struggle to make ends meet. And even within the wealthier countries of Europe, we see that the majority of people do not feel in control of their finances. So TFI will be a success if we can show a measurable impact of our actions on people's financial health. And one of the things that we are working on is an assignment that basically zooms in on people in the Netherlands and in Poland who have no or hardly any buffer savings. So TFI works to help the clients of several scale-ups. Those are companies with typically 10,000 or more clients. And TFI has been targeting specific ING clients with hardly any buffer savings. So we're using behavioral economics to nudge people towards saving more. And we aim to be as precise as possible in isolating and measuring the impact of our actions. And research is obviously the component that informs those interventions. Finally, this, money matters as an enabler of this much more important things in life. And wanting to have a more equitable society might seem political, but I think it just makes common sense, but it also makes business sense. Good luck to you, next speaker, Laurent Calvet, in moderating this event, and I hope it will really deliver some important and also practical insights. Laurent, over to you.
Thank you very much, Michael and Stefan, for these introductions. So the motivation for the panel, I think, is quite clear. Inequality in income and wealth have become a prominent feature of public debate around the world. Some distinguished economists have argued that the debate on inequality is simply irrelevant, and that policies designed to reduce inequality would simply hurt economic performance. Others on the liberal side view the rise in inequality as a threat to our economic system and even our democracies. So there is a wide diversity of opinions. The stakes are high, and we are here to discuss what scientific analysis can teach us about the links between inequality and financial markets. Now, we are fortunate to have here today with us 4 great panelists with enormous combined experience in economic theory, finance, tax policy, and international public policy. So we will proceed as follows. Each panelist has about 20 minutes to present his thoughts on financial markets and inequality. We will then hold a panel discussion around 6:30 p.m. London time or 7:30 p.m. Central European time. We will not interrupt panelists during their presentations. You can ask questions through the chat as usual, which will be then forwarded to panelists during the debating phase. I should add that we have invited a number of star women economists to participate in this event, but unfortunately they could not join us today due to a very busy schedule. So we are nonetheless sorry that the panel is not more diverse. I think the conference is diverse, but unfortunately the panel was more difficult to put together in that dimension. So let's start the presentations, and the order of the presenters simply reflects the time constraints of our different panelists. Okay, so our first speaker is José Scheikman, the Charles and Lynn Zhang Professor of Economics at Columbia University. So José needs no introduction, but let me just state that he has conducted extensive research on economic theory and finance with a focus on social interactions, trust, urban economics, and asset price bubbles, among many other topics. I should say on a personal note that José has been an inspiring figure to me since I started in this profession. In particular, I remember reading his seminal paper called The Injustice of Inequality, on the interaction between inequality and institutions. And this paper, if you remember, it was motivated by the Gilded Age and in the United States and transition economies in Eastern Europe, periods that are frequently referred to in the current debate on inequality. I should also add that José grew up in Brazil and has been a prominent voice in economic policy debates in his native country, which I think provides, another interesting perspective on the debate on inequality and finance, which is our topic today. José, the screen is yours.
Chad, thank you for this undeserved introduction, which is always fun to hear. So I'm going to share my screen, and I start talking a little bit about, there's a whole literature that makes an argument that high interest rates increase top wealth inequality. And I think the founding paper is a paper by Woelderen Whittle, but there has been a lot of attention by the work of Piketty and Zuckman and others. And there's a paper, Piketty and Zuckman, which connects fortunes, how fortunes grow relative to the economy. It's an argument as why low interest rates should increase inequality at the top. I think that's very important literature, but for us today, there's a problem because this whole literature ignores the role of financing in investment. And this is what I want to focus today, to talk a little bit about how does financing in investment alter this kind of results. And we're going to use two papers. I'll talk around two papers. And then one paper by Gomez and Guan Bonenfant, which are my young colleagues at Columbia. It's a very good paper. I urge you all to read it, that focuses on entrepreneurs. And then a paper that I wrote with Patrick Bolton and Thanos Santos that focus more on financiers. And I use then, I'll end by illustrating some of this idea using what's going on with SPACs, which I'll explain what it is. But what I want to get to is that that's going to illustrate my general skepticism concerning the role of financial innovations in lower inequality. And so let me start with a paper on entrepreneurs. The paper on entrepreneurs uses firms that produce homogeneous good with an AK technology. The TFP evolves over time according to a Markov chain with S state. When a firm gets a new TFP and decides their capital stock is inadequate or it's too low, or maybe the old one, they still decide the capital stock is too low. If he wants to have a growth rate of G, that is go from K to G times K, he has to invest I of G times K, units of the consumption good. YG, which is the numerator here, is the consumption good. IOG is a strongly convex function, which will tell you that, you make small investments, that's very cheap. You make large investments, that's very expensive. That's really, and we're going to assume today, for the purpose of this discussion, that firms are financed by debt and exogenous rate R. Now, it's important to notice that the entrepreneur demand for capital does not affect R, so that's exogenous. And in Gomez and Guan Bonenfant, they allow for fixed debt to equity ratio, and in their estimation, their calibration of the model, estimation of the results, they actually use actual leverage present in the most successful firms owned by entrepreneurs. Now, what you can see, but it's kind of obvious, if you have a lower rate of interest, that's going to increase the rate of accumulation by entrepreneurs relative to others. That's kind of an obvious consequence. What's much more subtle is that if you measure inequality by the inverse of the rate or exponent, you can actually write down some sufficient statistics, and that's what's beautiful in the paper, to connect inequality with some of the statistics of the distribution of firms. For those of you who like this stuff, this is connected to larger deviation theory, but that's not important. And what they do is they estimate that 2/3 of the increase in inequality in the US between 1985 and 2015 is accounted for the decline in interest rates. So the complete reverse of the usual logic, and the reversal comes because R here is a form of financing for lucky or good entrepreneurs. They don't make a distinction between the two. Okay. Now another paper that reaches the same kind of message with a different kind of model and a different motivation. I'm really talking about financiers. This is a paper that I mentioned with Patrick and Tano, and it's really about the marriage of capital and knowledge, which, by the way, that's also happened in the paper by Guan Bonenfant, but he's a little bit more explicit. So we have originators of projects that pay in period 2, but want to consume in period 1. Investors, so when they originate those projects, fraction E of good projects, they pay XH, and all the bad projects pay 0, which is 1 minus Z fraction. And those investors that possess capital K per capita in period 1, but want to consume in period 2. Okay, those investors, I'm going to tell you exactly what they're going to do, but they're going to be also financiers. They also may possess a larger amount of capital. Mu could be bigger than 1, but that's irrelevant at this point. And they also want to consume in period 2, but they also possess knowledge. They can distinguish good from bad projects. That's this marriage between the financiers and the financiers. We have to think again that there are few of them. They're not going to affect well, they're not going to have an effect on certain prices in the economy. So certain prices are going to affect, but other prices are not going to affect. So we have the stock. So we're going to have three markets. We're going to have a stock market where investors can buy projects that they regard as homogeneous at an equivalent price P. So those are uninformed investors. They have to just go to the stock market and buy something at price P. But then you have an OTC market where financiers can cream scheme good projects before they are presented to the stock market. And what they do is they're going to pay originators a little bit more. They're going to pay lambda XH plus 1 minus lambda P. So the lambda is kind of a measure of, I think some people object to that bargaining power. Some game theorists object to the use of this word, but that became the normal word. So when lambda is equal to 0, you're going to pay P. But if lambda is positive, you're going to have to pay more than P, more than the equivalent price. The idea is that an originator can always go to the stock market and sell their projects, so their reservation price is P. But on the other hand, the financier can always consume his XH tomorrow, just save the XH. So there's also secure loan market where financiers borrow from investors, but that's subject to a haircut, eta, which is exogenous, and equilibrium growth rate R. Now, what can you find in this model? Well, an equilibrium consists of a triple PD, which is the price that financiers are going to pay, P, which is the price in the stock market, and R, which is the rate of interest at which loans are made in the market. Now, in that paper, we use cash in the market price, but the only important thing is that prices respond to the supply of funds and to the number of projects that flow to the stock market. So equilibrium determines all the variables, but the ones that interest us are P, the leverage of financiers, L, and the fraction of projects, M, that's cream skipped by financiers. And you can also determine the rate of return. And Michael shows two things. As the economy becomes wealthier, the motivation of this paper was a savings glut. We have three things happening. You have R decreases, that is, the interest rates goes down, it's kind of expected, but also leverage and the fraction of projects that are cream schemed also increase, and the relative return of a financier purchase, which is, they always buying good projects, so it's XH divided by PD, relative to the return that an investor gets in the stock market also increases. But there's a second phenomenon, is that the increase in leverage further increases the wealth of financiers relative to uninformed investors. So in this model, that's what happens. As the amount of savings increase, both the wealth of financiers relative to uninformed investors increases, both because of the prices that gets generated, but also because the financiers can get higher amount of leverage. Now, you can also think about, and this will be closest outcome today of theoretical financial innovation, which is a decrease in eta. So what is a decrease in eta? The eta is the haircut. When you decrease eta, you're making the loan market more fluid. People can borrow more and with whatever collateral they already own, okay? But the decrease in eta increases the wealth of financiers while decreases the wealth of the uninformed. Just to give you a little graph here, I'm comparing two levels of haircut, eta equal to 0.5, which is a higher haircut than eta equal to 0.4. As the haircut decreases on the vertical axis, I have the relative wealth of a financier versus a common investor, and that is higher, of course. And also the increase in K also makes the financier richer relative to common investor. So I'm going to finish with a conversation about SPACs. And a lot of this material comes from the head of research, economic research at, and also I think he's the chief investment officer of JP Morgan, Michael Haliassos, was somebody who is worth following among the people in the industry. I think is one of the most intelligent analysts. So I'm a big fan. So the other day he sent me this thing on SPACs. So what he did a return analysis of 90 SPACs I assume you all know what a SPAC is. So those are companies which are created with a goal of doing an IPO. There's being by merger to a private company, that private company becomes traded. Okay, so this vehicle is created exclusively for that. It's a form of IPO, but it's very different regulations you see later. So he did a return analysis of 90 SPAC companies brought public or liquidated, because sometimes the SPAC never buys company, never merges to another company, between 1/1/2019 and January 22, 2021. That's about the time that those things have existed, okay, for 2 years, okay? Now, the SPAC sponsor has had a return, he calculates a 418%, even after considering all the concessions, the vesting that occurs at sometimes the times which they actually do the acquisition and so on, but it's 418%. Now, why do companies want to leave that much, give those guys 418%? They do have an advantage. So it's a little bit like the originators in my, they get paid a little bit better. So what they get is that they get a faster speed to market, which is very important today because nobody knows how long there's going to be this tremendous demand. The typical company that comes in is looks like a Russell 2000 growth company after the IPO, no? So, and the other thing is that SPAC has a very different regulation. In an IPO, you have a lot of restrictions about what you can say, how positive you can be about your company. None of that applies to SPAC. And in fact, the SEC has just made a recommendation that should be changed, but they really cannot do anything about it at this point. It has to be other regulators who have to be involved, maybe the law, but the marketing process is really crazy. They can use their own financial projections. Management can use their own financial projections, and you can't imagine how do they look to do it. Now, if you look at, he also look at the return, the median return of buy and hold investors. Now, some buy and hold investors did extremely well. If you bought Virgin Galactic, you did very well. But the median guy, and that encompasses both the upfront SPAC buyers, that is the people that gave the money to SPAC sponsors to do the initial IPO, the so-called private investors on public equity, which are the guys who usually bring about 50% of the money into the deal, because a SPAC usually, even after the SPAC buyers and their own capital, they don't have enough money to do the deal, so they bring in these PIPE investors. And then there's the post-merger buy and hold investors. They did much worse, and they do not beat the Russell 2000 growth. So in fact, if these guys had just bought the average company or the median company that they ended up buying, they would have done better. Okay, so this is one more example, and I think it's a very important question when you talk about innovation finance. The principal beneficiary of innovations in finance have been and continue to be, because this is one more example, the holders of specialized human capital. The people that invest in the SPACs, they don't do nearly as well as the guys who originates the SPAC. Of course, that takes a lot of specialized human capital. Thank you, Laurent. I hope I stayed on time.
Yes, perfect. Thank you very much, Jose, for your presentation. The next speaker is Florian Scheuer. So Florian is the UBS professor of the economics of institutions at the University of Zurich, and has held previously positions at Stanford, Harvard, and Berkeley. He studied the progressivity of the tax system, the income of superstars, and so talking about specialized human capital, and the taxation of rent-seeking activities, among others. His most recent research investigated the policy implications of rising inequality in income and wealth, with a focus on tax policy. Florian, the screen is yours.
Thanks a lot, Laurent. Let me also share my screen. Great. So thanks a lot for the invitation to participate here today. I really look forward to the discussion with my distinguished co-panelists. So Laurent asked me to bring in the perspective of public finance and inequality. And I guess at least grammatically, you can think of public finance as a subset of finance. So I'm going to talk about a little bit the role of tax policy and how it affects financial incentives, especially at the very top of the distribution, which is, as Laurent alluded to, is some of my the focus of some of my most recent research. So when it comes to the very rich households, the first thing I'd like to emphasize is that they're qualitatively different from the rest of us. For most of us, the bulk of our income is labor income, but at the very top, capital gains become incredibly important. So you see in this graph, which is taken from a recent overview paper that I've written with Joel Slemrod, that, for instance, for people making more than $10 million a year, realized net capital gains correspond to roughly half of their income. And in fact, when you just look at the 400 households with the highest income, so this is IRS data for the US for 2016, it's almost 60% of their income. Now, why does that matter? Well, capital gains are treated very favorably by most countries' tax systems at the moment. So for instance, Switzerland, where I live, does not have a capital gains tax, so they completely escape taxation. But even in other countries like the US, they are currently taxed at the lower rates than ordinary labor income. They're taxed based on realization, which gives you what's called a deferral advantage compared to when these capital gains actually accrue. And third, and most importantly, they completely escape taxation when you never realize them during your lifetime. So that's called the step up in basis at death provision. And in fact, Joel and I estimate that just because of that last provision, roughly half of capital gains never get taxed, even in the US. So taken together with the extreme concentration of capital gains at the very top that we've just seen in the previous graph, that of course means that overall tax burdens can become regressive as we go up the distribution. So you can be someone with a relatively high economic income and still face a relatively low average tax rate if most of your income is in the form of capital gains. And that's a problem that has been recognized. And in fact, there's an active current discussion about what to do about it, how to fix tax progressivity at the very top. And so one obvious solution would be to increase the tax rate on capital gains, or even to move away from the current system that we have, which is based on realization, towards an accrual-based system where we tax accrued capital gains, or at least to get rid of the step up in basis at death provision, which is called constructive realization, where effectively you'd have to, for tax purposes, realize all capital gains at the end of your life. And I think that's the path that the Biden administration is currently favoring. Another proposal that we've seen very prominently in the last couple of months is to have a wealth tax. The US has never had a wealth tax, but in the 1990s, there were still about 12 countries in Europe that had a wealth tax. At this point, most of them have gotten rid of it, and it's only 3 of them left, Norway, Spain, and Switzerland, that still have a wealth tax. And out of these 3, really only Switzerland is raising some non-trivial amounts of revenue from its wealth tax. The other 2 are not raising revenue as a percentage of GDP. And so even though it's not been sort of popular in Europe, it has experienced some revival. Most recently, it's been discussed frequently now in the context of the coronavirus pandemic. So it was just passed, in fact, in December. In Argentina, they decided to have a one-off wealth tax, kind of soft earmarked, to help finance the burden from the coronavirus pandemic. It's been suggested by the IMF in this context, and it's currently being discussed in other South American countries and South Africa, and a couple of US states are discussing it, like California, New York, Washington states. And of course, in the last presidential campaign, Warren and Sanders very prominently pushed for this. So Joel and I, in fact, have written another paper that just came out in the Journal of Economic Perspectives this February that discusses the case for a wealth tax, and in particular asks what we can learn, if anything, from the European wealth tax experiences. And so in this table, you see a summary of statistics about the design characteristics of the European wealth taxes. Shaded in gray, you see the still existing ones in Norway, Spain, and Switzerland, and compares them with the Warren and Sanders proposals from the presidential campaigns in 2019. And I want to highlight a couple of important design differences. The first is that the European wealth taxes have a top rate on average of about 1%, which is way lower than the Warren and Sanders proposals that were very progressive. You know, the Sanders proposal with up to 8% annual wealth tax rate on incomes in excess of $10 billion. So that literally just was targeted at about 50 people. The Warren tax with the top rate of 6%. The currently highest rates that we have in Europe is the 3.75% in one region in Spain. So the Spanish wealth tax is a region-based one. And historically, there were some countries like Finland and Sweden that, and also Switzerland after World War II, that raised up to 4% annual wealth tax rates, but that has come down a lot. So it's much lower than the US proposals. And the big difference is also that both the Spanish system and some Swiss cantons have a cap on the joint tax liability from wealth and income taxes as a fraction of total income. So this is intended to deal with the liquidity problem that some people might have very high wealth, but not a lot of income. So they would have the trouble to pay the wealth tax out of their income. And so they have this cap, which essentially imposes a zero marginal wealth tax on people who don't have high enough income, which the Warren and Sanders proposals, they would not have that. So that's another important design difference. Now, the other big difference is that the European wealth taxes, which I think contributed to their lack of success, had a relatively narrow base relative to the US proposals. So many of them had exemptions, which is marked with an E here, or tax preferences, which is marked with the TP here, for certain types of assets, in particular, main residence, life insurance, pension wealth, some business assets, whereas the basis of the US proposals are unprecedentedly broad in the sense that they would include all these assets and tax them at the full rate. And then the third big difference is that the Warren and Sanders proposals are much more progressive, not just in terms of their rates, but also in terms of who they target. They're really targeted in terms of their exemption amounts, where, you know, below which you wouldn't have to pay any wealth tax. They're targeted at millionaires and billionaires, whereas most of the European wealth taxes were and are much more broadly based. So the average exemption amount currently is about $500,000. And many people in particular ask me about the Swiss tax experience, because Switzerland, as I said, really it's raising about 1.1% of GDP with its wealth tax, which is roughly in the same order of magnitude as the US proposals. And it's much higher than what any of the historical and currently existing European wealth taxes is raising. So the question is always, you know, is the Swiss experience kind of a good example to learn for what might be happening with the wealth tax in other countries? And you see that the Swiss wealth tax, again, has these much lower top rates. They range between 0.1% in some cantons to at most 1.1% in the canton of Geneva. Actually, most cantons have a top rate of below 0.5%. And the exemption amounts, again, are much lower. They range between $50,000 and $250,000 for married couples. So the Swiss wealth tax really is, even though it raises similar amount of revenue, it's much less progressive, and it's targeted at a much larger share of the population, not just millionaires or billionaires. So while the Swiss wealth tax kind of is the only modern example of wealth tax in an OECD country that has been able to generate sizable revenues in the long run, I think it's particular in the sense that, you know, you have to keep in mind Switzerland does not have a capital gains tax. It also doesn't have an effective estate tax, because most cantons abolished estate taxes to direct descendants. So you can think of the Swiss wealth tax as a kind of backstop to substitute for these missing instruments that many other countries are using extensively to achieve some redistribution of wealth. And we still have bank secrecy in Switzerland, and when it comes to the valuation of business assets, which is always the notoriously difficult thing when it comes to a wealth tax, they're using a sort of pragmatic formula-based system, which is basically a weighted average between the book value of assets and capitalized profits in past years. But there's a lot of discretion on the part of the tax authorities how exactly to value privately held businesses. And so I think both that and the limited enforcement because of the bank secrecy, so there's no third-party reporting of financial assets, sort of contributes to an equilibrium where the wealthy are feeling treated rather leniently, even though we've had that wealth tax for a long time. Now, what do we know about the behavioral responses to the European wealth taxes? And in the paper, we review recent studies that have been done looking at different response margins, and they find substantial overall responses. But what we emphasize is that the anatomy of these responses, whether it's real responses in terms of people's savings behavior or investment behavior, or avoidance responses in terms of what kind of assets people are investing in, depending on the base of the wealth tax, or even outright evasion behavior, that anatomy varies a lot across studies and across countries, in large part because of the design differences across these European wealth taxes. I think some of these European wealth taxes really had design flaws in the sense that they have had fairly narrow bases, so it was easy to avoid them by shifting into tax-exempt assets, which could be overcome by these recent proposals. But I think in terms of real responses, the one we're typically most worried about is the incentives for entry into entrepreneurship and the control of business enterprises. So that's, you know, if you think about, for instance, the Forbes 400 list of richest Americans, you know, 3/4 of them are self-made founders of their businesses. So we might be worried about, given all the innovation that is going on in these firms, that we might discourage that, and we would want to avoid that. And I want to talk a little bit about that because that's the focus of some of my most recent research. So some of the concerns that have been raised are that, you know, entrepreneurship is a highly risky undertaking. And with a highly progressive wealth tax, that could discourage entry into entrepreneurship and entrepreneurial risk-taking. We know that entrepreneurial returns are very skewed, with most startups not faring very successfully, but very few of them doing exceptionally well. And because of incentive problems, that risk cannot be diversified, so the entrepreneurs have to bear that risk. And that already under reasonable risk aversion reduces the attractiveness of entrepreneurship. So it might be a bad idea to further reduce entry into this by having a higher tax burden on the successful outcomes. Another concern that is that the wealth tax might actually force entrepreneurs to continuously reduce their ownership share in their companies. If you have a startup company whose valuation rises over time, and then you cross the threshold for the wealth tax, and you'd have to pay wealth taxes every year. And if you don't have the liquidity out of the profits of your startup, then you'd have to pay for the wealth tax by essentially selling shares every year. And by selling shares, in addition, you realize capital gains, so you trigger an additional capital gains tax liability. So you'd have to sell even more shares. And so that would lead to some additional dilution of the control rights of these entrepreneurs. And even if they're not primarily motivated by monetary incentives, but if they really care about realizing their ideas, that additional dilution in terms of control rights that could discourage their entrepreneurial activity if it makes it harder to actually realize what they want to do, given that they now hold a smaller share of the company. And then the third point that I think often is overlooked but goes in the opposite direction is that if you make such a tax very progressive, it becomes essentially a tax on the low probability state of the world where you are very successful. you know, if you have a successful exit, like an IPO or an acquisition, where you become a billionaire, in that state of the world, your marginal utility or risk aversion is going to be fairly flat. And so having a higher tax rate in that state of the world might have relatively modest effects on your ex-ante decision, or whether to enter this or not, because it's sort of the tax on this low probability state of the world where you don't care much about an additional dollar. And so I have a recent research project with Eduardo Acevedo and Ken Smathers that is trying to quantify exactly these considerations and see what we could, what the effects of a wealth tax would be in a dynamic model of entrepreneurship that is sort of empirically calibrated to the actual distribution that these entrepreneurs are facing. And so we try to estimate that distribution. We have some novel data on the essentially universe of venture capital backed startups in the US. And we observe their funding rounds and their exit values and the founders. And so we're trying to compute the distribution of payoffs to the founders. And what we find is that this distribution is extremely well approximated by a Pareto distribution with the coefficient that is very close to 1. So it's very close to Zipf's law. So what I'm showing you here is the typical Zipf plot that we're doing to check whether a distribution has a Pareto tail. We plot the log of the values against the log of the ranks, which is 1 minus the CDF. And if that converges to a straight line, then we have a Pareto tail, and the slope of that line gives you the Pareto coefficient. So that's what we're doing here. And you see that for a large range of the support of the distribution, this is very well approximated by a straight line, and the coefficient, the slope here, is 1.1, which is much closer to 1 than many other distributions that we're used to. If you think the income distribution has a Pareto tail of roughly 1.5, the wealth distribution a bit smaller, but this is much more skewed than that. So indeed, it's a very skewed distribution, and with kind of standard risk aversion, they value this lottery ex ante at a big discount, at roughly only 20% of the expected value. So there is, from that perspective, there's under entry relative to a situation with full insurance, but at the same time, we can also show that the elasticity of entry with respect to the capital gains tax rate. So if we now impose, instead of the current 20% capital gains tax at exit, when you sell these shares, something higher, that elasticity becomes very, very small just because of that extremely skewed distribution. So the tax rate itself doesn't have to have a big effect on entry into entrepreneurship, but what we also conclude is that the tax regime shifting from a realization-based capital gains tax to a wealth tax could have potentially large dilution effects. So what we're computing here is the distribution of ownership shares at exit that is owned by the founders. So what percentage of the company is owned by the founders taken all together? At exit, you know, there is dilution because of investments by venture capitalists and so forth. In the current situation, that's the blue histogram, where essentially before exit, there's no tax liability because it's all realization-based currently. So as long as you never sell your shares, you don't have to pay any taxes. Only when you have an IPO or an acquisition, you sell these shares, then you'd have to pay capital gains taxes. So that does not affect dilution. Whereas when you change to the Warren wealth tax, that's the simulation we're doing here, where even before exit, potentially, if your company is doing well, you'd have to start selling shares to pay the wealth tax every year. And in addition, capital gains taxes when you sell these shares. You see that that would reduce the ownership shares significantly. In fact, we find that on average, it would reduce average ownership from 45% to 25%, roughly half it, and shifted to the left. And that's just the mechanical effect. It's holding the distribution of valuations that we see in the data fixed. There could be additional behavioral responses that now that you have the wealth tax liability, you might want to delay new funding rounds because you're worried that, you know, your valuation goes up and that triggers higher tax liability. Or you might try to negotiate lower valuations with your venture capitalists. Or you might even avoid to go public and have an exit if you think that, you know, staying private helps you hiding your wealth from the wealth tax. So what we conclude from this is that the tax regime seems to matter more than just the tax rate. And so at a conceptual level, and that's the last thing I want to briefly...
I just want to tell you have 1 minute left.
Yeah, that's my last minute. What can we say about the advantages and disadvantages of having a wealth tax versus a capital gains tax? And there's actually a tight relationship between the two. If we all have a 4% rate of return, then a 2% wealth tax is like a 50% capital gains tax. If we all have a 2% rate of return, then 2% wealth tax is like 100% capital gains tax. So you already see that when different wealth holders have different rates of return on their wealth, then a wealth tax favors those with high rates of return. And it really hits hard those who have low rates of return, who are just sitting inactively on their wealth without any good ideas what to do with it. And that's in fact an old observation that goes back to Maurice Allais, a Nobel laureate, who observed that that's a big advantage of the wealth tax, right? Because it could potentially encourage the reallocation of capital from unproductive people to productive people. On the other hand, because a wealth tax is a unit tax on the rate of return, it only targets what we call the normal rate of return, not any excess returns, which could include rents from monopoly power, but also shifted labor income. If you think about my startup example, that gets all treated as capital gains, the income of these founders, but really it's the compensation for the labor effort of these founders during the early years of the company, which should also be taxed. And a wealth tax doesn't do that, but a capital gains tax at least does that partly. So I think we've made much progress in documenting and measuring rate of return heterogeneity. I see Luigi Ghiso here, who has written an important paper on that. But what we'd really need for the policy question is the decomposition into how much of it is real rate of returns, differences versus rents and shifted labor income. And I think that's where I'm circling back to household finance. I think much more research on precisely that decomposition would be extremely important for us public finance economists to actually figure out which policies we would prefer in order to redistribute wealth and capital gains. Thanks a lot.
Thank you very much, Florian, for this thoughtful discussion of taxation, its consequences, and how heterogeneous it is around the world. Now we're going to move to our next speaker. So our next speaker is Alberto Bissin. Alberto is a professor of economics at New York University. He's held visiting positions in at MIT, Stanford, UC Berkeley, UPenn, and many other institutions. He's also an op-ed editor of the Italian newspaper La Repubblica. Alberto has written extensively on the economics of cultural transmission, and more recently on the dynamics of wealth inequality, income inequality, and fiscal policy. So really some of the topics that are at the heart of the panel. He's also an expert on financial markets in the presence of information asymmetries. Alberto, the screen is yours.
So thanks, Laurent. It's a great honor to be here. It's true I worked a little bit on wealth inequality. I'm far from an expert, but I'll try and say what I know. So this is joint work. So basically, I've been writing on wealth inequality. So it's going to be mostly on wealth. I've been writing for some time. All that I've done is with Jesp and Habib, my co-author here, my colleague here at NYU, and a few students and co-authors, Shengao Zhu, Miluo, and Ricardo Fernand. So I'm going to to talk quickly about three issues that I've been working on and that more or less shape my way of thinking about wealth inequality. And that all, you'll see the connection with the finances, that all of this is centered on the role of returns on wealth, which we kind of model simply, you will see. But that's the point. Okay, so 3 points. One is that I want to make is that, when we look at inequality in wealth, there's a long discussion, there's a lot literature, a large literature in economics about, inequality on earnings, in some sense causing or being at the root of the inequality of wealth inequality. And so the first point I want to make is that it's really not earnings. Okay, so in a fundamental way, then of course earnings has an important role, but inequality of wealth is driven, I want to argue, in a fundamental way by the returns on wealth. The second point I want to make is that a lot of the macro models that we use on the distribution of wealth are basically compare stationary distribution from the models to data, right? So basically what you do is you run a model up to a stationary distribution, and then you compare that stationary distribution with the distribution of wealth, for instance, in the US 2019. Okay, and I want to argue that and again there's a literature here which is arguing that that we can understand stationary distribution, but that the dynamics is much harder, and that we don't have good models to capture the dynamics of the distribution at the rate that it actually happens at, right? So at the historical rates. And I don't want to argue that that's not that bad, in fact, that we can do this. And the last point I want to make is that there's a large literature, also maybe not that large, there's a literature nowadays which discusses various elements of long-term persistence, even historical long-term persistence of wealth, and it's not that easy actually to generate this in our models. So I want to think about a couple of issues that arise here. Okay, so the slides, I should say, the slides have been written, to be posted. So there's much more than in the slides that I will be able to say. So I will guide you through. You don't need to read carefully. Okay, so the first set of slides is about earnings and wealth distribution. Okay, and I want to make this. I first want to make a very simple, if you wish, theoretical point that cuts through the problem in many ways, but I think gets to the core of it. Okay, so remember the question is earnings versus wealth, or what is the role of the earnings, distribution of earnings, how thick are the distribution of earnings to understand distribution of wealth, right? So if you start, for the moment, no micro foundation, start with a linear model, a linear accumulation model of wealth, right? The one in equation 1. W is some rate of return on wealth. The C accounts for some sort of micro foundation. So these were the slides I just talked about, the three issues. Then can you go down, please, to slide 3? Okay. So this is the one I was talking about. Okay, so earnings and wealth inequality. As I said, just let's look at a not microfounded or not completely microfounded simple model. It's a dynamic equation of wealth. W is WT plus 1, returns is R, and YT plus 1 is earnings. The Greek letters are accounts for consumption out of wealth and out of earnings. So you just look at this equation, and we think of this. We think of Y, which is earnings, to be a random variable, possibly with a thick tail, and we think of R to be the rate of return on wealth. Okay, under some assumptions, so that this is a well-defined Kasten process. This thing as a stationary distribution of wealth. Okay, so you run this equation and you have a stationary distribution of wealth. Okay, so now the issue is there are two dimensions which can generate thickness in the tail, right? So large inequalities of wealth, it's measured, statistically, mathematically by thick tails. And what this result says, you don't need to get into the detail. It basically says, look, there are two dimensions from which you can get thick tails. One is if you have thick tails in earnings. So if earnings are very unequal, well, that translates into unequal wealth. And then you can have this stochastic R, which is the stochastic dimension. Think of them as entrepreneurial returns. Okay, so idiosyncratic returns that increase wealth. Okay, so that's the other dimension where you can get thick wealth. And this result says something that it's obvious ex post when you think about it, but to me it wasn't at the beginning. It says it's not that the outcome, the thickness of the wealth that comes out of this equation is a combination of the two dimensions. It's either one or the other. Okay, so basically, if the returns are not enough to generate a thick wealth, then your wealth distribution is going to be thick because of earnings, and it's going to have the same thickness as earnings, okay? While if rate of returns play an important role, then, you know, the thickness in the returns to wealth only counts to the multiplicative factor, which is the one, which is returns, and the earnings have no role in the tail of the distribution, okay, in the limit, of course, right? Of course, in the left part of the distribution, earnings still play a role, but they have no result on, they have no, you know, they don't matter that much for the tail of the distribution, okay? And please, can you give one more quickly? Okay, so this is just a slide to say that, you know, this model, we're just looking at linear, this argument is based on linear wealth accumulation equations, but really we can actually do some interesting, I would think, for those who are interested in these things, interesting ways in which you can actually map, at least asymptotically, the linear wealth accumulation off of a nice micro-founded Iagari-Bliuli kind of economy with rate of return. Okay, so next one. So now, why is this important? Why is this result important? The result is important because we all know, even Pareto knew this, the wealth distribution is much more unequal than the earnings distribution. Okay, so I'm measuring it here with Gini rather than the index because, you know, that's because there's more data, there's more, it's been done better. But basically, the wealth is more unequally distributed than earnings. And then the result before is telling us that the distribution of wealth is going to be driven by returns. It cannot be driven by, in a fundamental way, by earnings, because if it were earnings, then they would have the same, basically the same Gini or the same inequality at the top. Okay, so that's the result. Next one, please. So we've done. Jess and I with Mi Luo have looked at this result from a more standard classic macro way. We simulated a model of consumption savings, and we looked at the distribution of wealth simulated from that model. We estimated returns. We estimated a bunch of stuff. And we computed, and this is what it's in this picture, we computed a bunch of counterfactuals. Basically, the one that I want to talk about now is, suppose you take this model and you assume, though, that the rate of return is not stochastic. If the rate of return on wealth is not stochastic, is fixed, then you cannot, by the argument before, the only reason why the wealth is thick is earnings and maybe some kind of non-homogeneity in accumulation of savings. That is the mu that we have here. So if you look at the upper panel to the right, 99 to 100, that is the top 1%. That's the wealth share of the top 1%. In the data is 33%. The model with both random return and earnings gets to 32%. But if you kill earnings, if you kill the random rate of return, the maximal share of wealth at the top 1% that you can get is 15%. Okay, so this is the dramatic counterfactual, which says, look, you gotta have earnings. Okay, so that is the first of the points that I wanted to make. Can you please go over? The second point that I want to make is about non-stationarity. So the way we've done this, of course, and the way everybody else has done this kind of exercises, as far as I understand, is, again, you have a model, you run the model, you simulate the model up to the stationary distribution, and then you compare the stationary distribution with the stationary distribution, with the distribution of the in the data, wealth distribution in the data, which in this case is SCF 2019. Okay, so we have tried in future work, in work that we are doing in progress with Mi Luo, Jess and I, with Mi Luo, we are trying to actually account for the whole dynamics of the distribution of wealth in the US from 1962 until 2019. Basically, the procedure, we're running basically the same model, But what we're doing is very different. Well, basically, what we do is we start with the initial condition. We throw into the model the initial condition, which is the wealth distribution in 1962, and then we run the model, and we estimate it to match the dynamics of the wealth distribution from 62 to now. We have it. Of course, the data is there's not all the data we would like is there, but we see the wealth distribution in the US in 62, and then we see it again in 89, and then after 89 for every 3 years until 2019. There are issues with how we model taxes because one of the fundamental non-stationary dimensions of this process is the tax rates. Okay, so there's been several tax cuts, and there's a whole issue of how did agents anticipate the tax cuts and so on. We play a lot with these issues, perfect forecast or not perfect forecast on part of the agent. But let's go ahead. So this is just about tax rates. Just want to give you the result. Please, let's see.
Alberto, Alberto, if you could conclude in like 3 or 4 minutes, that would be.
I'll be very
ideal.
quick.
Yeah.
Yes. So this is the left is the data and the right is the simulation, the simulated, and you see that we can cut this model at the actual speed in terms of a year is a year is able pretty well, I would say. I mean, we're not at the end, but it's able pretty well to get the shape and the dynamics of the various wealth shares from 62 to now. Okay, so I just want to say this is useful. Next one, a couple of points. So there's data. So this data is whatever it is. They are looking at rank correlation in wealth over hundreds of years, right? So there's some data. Clark has done it for England by surnames. Other people have done it by occupation for Florence, and so on. And there's also large, this is easier, grandparent-child correlation, even conditioning on parents-child correlation, right? So the whole idea here is that wealth might be very persistent over centuries, and so we are trying to look at what our models imply with this. So again, this data is not high quality data. It's historical data, so you might buy it or not buy it. But if you do, let's try and see what the models do. Please, next. Basically, the only equation, given I have only 2 minutes, I think the last equation is the one that I want to look at. Basically, what we do is, in here, this is with the Carnot-Fernolds, we look at our rank based dynamics and that gamma there. So this is the equation for wealth that we calibrate. The growth of wealth is got the alpha, which is a growth rate which depends on the rank, and then there is a gamma, which is a growth rate. I mean, an element of the growth rate that it's indexed only by I, which is the dynasty. Okay, and then there's volatility. Okay, next. So basically here, what we want to do here, want to show here is that the first column is data, the second column is the approximate rank-based model, which basically means the model I had before, an approximation of the model I had before, a standard macro model, a standard Kesten model. And the third one is this model where I added a permanent component of the growth rate of wealth on dynasties. And basically, without that, you basically cannot look at the last row, the long run persistence. It's very clear. It's 0.1 in the data, it's 0.1 with the permanent heterogeneity model, and it's just 0 in the standard model. So we played with this. Please, the next. I'm done, really, Laurent. I see you worried. I'm done. We played with adding autocorrelation across generation of returns, and even autocorrelation of returns over generation don't work, because basically if you add autocorrelated returns, what happens is that you need to jack up this autocorrelation very much to get, for instance, grandparent-child rank coefficient, but then it declines exponentially. So really the way we think, this is really at the beginning of what we're doing, but the way we think is that it's really a permanent model a permanent heterogeneity model with a lot of variance around the rate of return on wealth, but that kind of, it looks like in this exploration, is kind of like the only one that can capture long-term persistence, the long-term persistence in the data. Okay, so I had a conclusion, but I'm done. Thank you.
Thank you very much, Alberto. So we can now move to our next speaker. So our next speaker is Jeff Sachs, Jeffrey Sachs. He's the director of the Center for Sustainable Development at Columbia University, and is the president of the United Nations Sustainable Development Solutions Network, as well as an advocate for UN Secretary General Antonio Guterres on sustainable development goals. Jeff Sachs was named one of the most influential people in the world by Time Magazine, I think on several occasions. He's been a leading voice in global economic policy debates since the early 1980s. Jeff's work spans areas such as post-communist transitions, economic development, sustainability, and disease control. Jeff has both widely published on these topics and has acquired enormous experience on the complexities of implementing economic solutions. So we truly look forward to Jeff's insights on inequality and financial markets. Jeff, the screen is yours.
Thank you very much, and happy to be joining, though I'm surely the least informed of all of the people speaking right now. I caught the tail end of Alberto's wonderful presentation and want to read the paper with care, because this is really the kind of modeling that we need to see whether we can explain the extraordinary and growing inequalities of income and wealth that we're seeing, especially in the United States, but not limited to the United States. I think probably the only, I hope, mildly intelligent point I can make about this right now is the importance for us to understand the differences across the high income countries. Because I think what is happening in the US really is very different from what is happening in especially Northern Europe, but I would say Europe in general. And so any relatively pure macro framework like Alberto just presented, if it captures the US, it's not going to capture what's happening in much of Europe, I would guess. And anything that describes Europe is going to miss the US. I believe that the reason is rather straightforward, and that is that so much of the inequality depends on the fiscal structures of countries and the role of government in distributional issues. And so much of what is wrong in the United States is the failure of our fiscal state to create anything remotely fair in the United States. Quite the contrary. We are the most oligarchic, plutocratic of all of the countries that call themselves democracies. And the US political system is absolutely geared towards the interests of big wealth, and increasingly so. With the most recent campaign estimated to have expended $13.1 billion, much of which came from the wealthiest Americans and the largest companies. And that's indicative of what's wrong with the politics. So my comment would be to Alberto and to other presentations that I didn't see, the extent to which one can track both a Denmark and a US in a framework like this, that by incorporating crucial parameters of fiscal policy. It seems to me that the biggest difference of fiscal policy well, there probably are several, actually. I'm not sure of the answer of this, but in terms of income distribution, as opposed to wealth distribution, the biggest difference is the socialization of consumption in Europe for major categories of spending, for health, for education, for a significant part of housing, and for some part of child rearing. This is socialized in Europe and privatized in the United States. So there is probably a gap of 10 to 20% of GDP that in Europe is pretty much, if not uniformly distributed, nearly so. And it's the crucial kind, because it is the kind that leads to human capital that then has a great deal to do with earnings variation in the OLG framework. And the United States privatizes almost everything about child rearing and education above the secondary level. And so we see poor households unable to get their kids through college. And in fact, worse than that, they end up with a lot of debt and without a bachelor's degree, and end up with a mess that they have poor jobs, precarious employment, and a lot of student debt on unfinished college degrees. And that's 10 to 20% of 25 to 34-year-olds in the United States. Or they end up with a 2-year, what we call an associate's degree, which isn't worth very much in the labor market, and still with a lot of debt piled up. And nothing is like that in Europe. So this is one major part of fiscal policy that I think is fundamentally different. The US right now is spending on general government, well, this year is, of course, bizarre, but pre-COVID, spending about 36% and collecting in revenues about 30%, whereas in the OECD, especially Northern Europe, it's 45 to 50%. So we're talking about a difference of perhaps 15% of GDP and a very significant proportion of income of the bottom 40% of the income distribution. The other difference would lie in fiscal policy. On the tax side, I don't really know whether that's a big difference between Europe and the US. Of course, Europe relies much more heavily on VAT, which is not especially redistributive in any way. Probably if there are differences that are significant on the revenue side, they would be in intergenerational transfers. The US is extremely promotive of intergenerational transfers of big wealth. So there are countless ways to protect an estate, countless ways to create trusts, countless ways to avoid estate transactions breaking up large wealth. And my guess is that a lot of the wealth inequality is intergenerational. And I think Alberto was referring to that in the end, but I didn't catch quantitatively how much that is. But this is the other area that I would want to investigate. Europe's not bad at protecting old wealth either, but my guess is that there would be less intergenerational wealth transfers in the European context than in the US context. So I think I will actually just limit my remarks to these brief points. To my mind, among the 1,000 interesting questions we face, one that absolutely I think is crucial for the survival of my own country is the difference of Europe and the US. The reason I think it's crucial for the survival of my own country is that the US is falling apart with all of this inequality. Our social bonds are disintegrating. Our wealth and income gaps are out of control. our politics is plutocratic. And I would like to make the argument that Europe does better because of its policies, and that there really are lessons for reducing wealth inequality through fiscal means. Maybe the last observation I would make, just to not to filibuster my time, but to make one more observation, is that all of this is going to get worse with the increasing digitalization of the economy, because the basic underlying economic force of digitalization is to raise the returns to various kinds of capital and to lower the returns to raw labor. And so in an OLG context, we're going to see an intra-generational redistribution of wealth to the top, and we're going to see an intergenerational transfer to old wealth holders away from young workers that only have their labor endowment. This is going to widen income inequalities and wealth inequalities with increasing intensity, because the wealthy beneficiaries will not consume all of their wealth as they would in an OLG model, but will transfer a huge amount of their wealth to the young generations. We will create rich dynasties in the US, and we will create dynastic impoverished households as well. And so I think we're going to see an even further increase of intergenerational transmission of income and wealth from what we've seen before, pushed by the increasing digitalization of the economy. In the end, maybe Jeffrey Bezos will own everything. I wonder if you can make the OLG model end up with one person who owns everything and no one else having any work other than nearly for free. But I think that's the path that we're on right now, unless we socialize consumption to a very significant extent. So that's the basic point. Let's compare Europe and the US in these dynamics, and let's anticipate further technological processes that are going to exacerbate the kinds of inequalities that we've seen. Back to you, Laurent.
Thank you very much, Jeff. Thank you very much to our four panelists for a very thoughtful discussion of wealth and inequality. So now we are going to move to the discussion phase. And I think with the way we're going to proceed is I'm going to be asking some questions and maybe calling on one of the panelists so that we minimize on, slow time. So I think there are several, I think it's really several topics came out of the panel. One topic I think is the issue of returns, right? So Alberto developed models of wealth inequality based on returns. Jeff emphasized the importance of returns and the fact that, so one of the topics really is that the average return on net worth tends to increase with wealth, right? So the wealthier you are, the more you earn on average. And we have evidence of this, empirical evidence of this coming out of a Scandinavian country. We talked about Luigi's paper on Norwegian data. Laurent Bach, and Paolo Sodini and I were all here on this call, are also worked on this, and we looked at the data in Sweden, and what we found is that indeed, returns, average returns tend to increase as you move up the wealth distribution. There are differences between the studies. We tend to find that the higher expected return, the higher average returns earned by the wealthy tend to be linked to higher levels of risk-taking, higher levels of systematic risk. Okay, Luigi emphasizes more the role of skill. But in any event, what I wonder, is we're here also to discuss possible solutions, and that's also the sense of the Think Forward initiative, as was explained earlier by Stefan. So one question maybe to Jeff first is what kind of products could we design to mitigate the impact of heterogeneous returns on wealth accumulation? Do you think we can come up with good financial products? So, I mean, one example before I yield the screen is, so with co-authors, with Boris Valle, Claire Sellerier, and Paolo Saldini, we looked at, for instance, the effect of capital guaranteed products. So we looked at products that offer households a capital guarantee, because we thought that, if rich households can take more risk and thereby our earnings, perhaps one solution is to allow middle-class households or lower middle-class households also participate in markets that earn, that yield higher average returns. And so capital guarantee would be one way to do so. But I was wondering if you had some thoughts about, what kind of products could be designed to reduce the adverse effect of return heterogeneity and inequality.
I don't offhand, because I think when these exceptional, can you hear me?
Yes, absolutely.
Oh, yeah. When these exceptional returns are available, first, they're coming in a systematic way, which is the winner-take-all markets and the increasing returns motivated by tech-related externalities. Of course, that's creating some young 17-year-old billionaires also, but it is generating a remarkable shift of income to the very richest individuals, and with opportunities that are not in publicly traded securities as well. So I'm not sure that it's, especially given where the big wealth is being generated right now, whether it's so easy to do with new products as opposed to compensatory actions of fiscal redistribution. But I'd be interested to hear if others are more optimistic on that.
So actually, yes, we did look with Laurent Bach and Paolo. We did look at what explains, the dynamics of top quantiles, like the top percentile. And in Sweden, that's what we found. We found out the reason why the share of the top 1% is going up is not so much that there is inertia. It's more that, the richest, the people who are making it now are just richer than the people who made it a generation ago. And this is what's pushing up, right, the top 1%. So indeed, that's a concern. There's a lot of idiosyncratic risk there that is also increasing inequality. But anyway, maybe one of our panelists one of the other panelists would like to share their thoughts.
Yes. I may have something to say on that, because I think the example I gave of specs is exactly that.
Yes.
People come in and say, I'm going to make available those returns of going public to common people. And what you see in the numbers, that's not what happens. The initiator specs are collecting a high return, and the people that are participating on these are getting, in fact, lower return they could get just because if they just were to buy a random portfolio with the characteristics of the investment they did. So I think the problem is exactly that, right? I mean, it also is true about tech. Especially in the US, there's a lot of combination of specialized knowledge with the opportunities of generating. And there's a lot of leverage that can go on. So the paper by my colleagues Gomez and Gwen Bonenfant make that very clear. You can see in the data, the top people, the US has more new people that got to the top than Europe. And the reason is because you have these extraordinary opportunities for people to have some specialized knowledge or get lucky, whatever it is. They can make those things happen. But I do think that nobody shares those things. When you see a product that seems to share, and I tend to be very, very wary when people show me guaranteed products and they think I know something about finance. This guarantees, which are like options, are priced incredibly expensive. So in the end, I tell people, I say, look, you're going to buy a product that presumably guarantees you, but the people doing this, they are basically hedging this risk very cheaply in markets because they know how to do it. and selling you something very expensive. So there may be exceptions. There may be guaranteed products that are generated by nice people, but I haven't seen that. Let's put it that way.
So in Sweden, there is a vibrant market for capital guarantee products that, that have priced pretty well, in the sense that the surplus is shared between the banks and the investors in a pretty fair way. But that may be a European.
That would be quite that would be quite an innovation. I wouldn't suggest people walk into Citibank and say, give me a guaranteed product so I don't lose money in the stock market. I know how it's going to be charged, but there may be other people that created products that can do that.
It would be very un-American.
Can I ask a question?
Sure. Go ahead, Luigi.
Suppose that, if you look at the distribution of returns, you see that there is a very long tail on the right. There are some people that make extraordinary high returns. So it seems that, and those are the ones that are really driving the concentration of wealth at the top. And also are the ones that can explain why the accumulation of wealth at the beginning of the dynasty is so fast. Just descriptive evidence tells you that there is a founder that accumulates a huge amount of wealth, and then there is the issue of how to preserve it for the next generation. That, I think, is what Alberto was alluding to at the end, trying to explain the persistence. To me, it seems that there is a big asymmetry, that wealth gets accumulated very, very fast, and then tends to be decumulated at a very relatively slow rate. Once you make up to the top, then moving people from the very top is hard, and it tends to persist for a generation. And one explanation is that you can bequeath the assets, but you cannot transmit the ability to generate the returns. So the first generation is super clever, makes a discovery, could be this specialized knowledge that Sheikman is alluding to, could be the setup of a big corporation or whatever. And then what the next generation has to do, you don't need to be super clever. It is enough to put all the pot of the money into a fund, and you can live for years and years out of the returns. Clearly, you lose if you do nothing. You lose in terms of relative position in the very long run, but meanwhile you can still be at the very top. So my impression is that it's extremely difficult to invert this process. Maybe the products that we are suggesting can be useful to sort of kind of dilute the tail on the left. And so give an opportunity to people that are in the middle class, perhaps at the bottom of the wealth distribution. I think that is probably useful. But in terms of contribution to the sort of diluting significantly the main observable fact that wealth at the top is super concentrated, my impression is that that is not going to help all that much. In order, seems to me that in order to be effective, what you need to do is to tax returns extremely heavily. But if you do that, that was the point that Florian was making. If you do that, you are probably taxing the ones that are exactly in the climbing phase of the wealth accumulation, which is probably the most productive capital that tends to probably to be reinjected into the business. So I think there is a sort of dilemma. If you tax wealth, probably you can tax it at 2%, 3% rate, but that is not going to change the basic fact. If you tax returns, you need to tax them super heavily, but then that is costly in terms of efficiency.
So
what about taxing them at the estate or at inheritance?
Yeah, that is that could be an option that, but that is going to break down, the persistence component.
I think that's it's a good segue, because I wanted to talk about financial products for the middle class. I think the next topic obviously is taxation, and we had a lot on taxation. So one question that I have is for the panelists is, how politically feasible is it to modify the tax policy? I think Jeff mentioned that in the United States the situation is quite complex. In Europe, I think the rates of taxation are more heterogeneous. I think there's more diversity, as Florence showed, and also in the context of international competition. I mean, what are the chances that countries would dramatically challenge their tax systems in a way that would actually reduce inequality, especially at the top? So I don't know if one of the panelists want to, or someone in the audience wants to answer this question.
Can I say a quick thing on this, which I want to connect with what Luigi was saying before, right? So there's clearly is a large demand, I think, in the population for redistribution, wealth taxes. We've seen that. Okay, so in some sense, to me, the issue is to do that well, and because it's going to be successful if you do it well, and it's not easy exactly for the reasons that Luigi was saying, right? So I would add something else to that. So there's two dimensions. One is, of course, that you are so if everything we're saying is correct, which is that a lot of this wealth is in some way comes from entrepreneurial activities, very successful entrepreneurial activities, then of course taxing wealth or taxing returns is might generate problem on the picking up, right? So then we tend all to agree on the fact that we can taxing estates would be better, because then you're taxing what it's less what is probably less productive wealth. But even I would add to this even more so, right? So this I've been thinking, as I was saying before, I've been thinking a lot about this long-run institutional dimension. I don't think that the picture is exactly what Luigi was saying, which is there's a guy who makes a lot of money, and then there's the kids who slowly, if they're smart enough, they slowly take it down. I think there are all sorts of institutional issues that make it easier for the kids to make it. Again, maybe not that big, right? But there's all sorts of dimensions where, from schoolings and all these things, right? So the competition in this country for top schoolings of the rich is crazy. And so all of this, and there are a lot, and of course, peer effects, friends, knowledge, networks, whatever. So so the point I want to make is that the kid of the rich guy has already a lot of advantages, which untaxable advantages, without the wealth. So in some sense, my point of view is taxing estates is where you can go. Now, whether that's easy to do also from the evasion standpoint, that's a thing I don't know. It might be very hard to do, but.
Laurent, can I ask Alberto,
maybe
how does your model do in tracking the US and then alternatively tracking a less unequal place? Yeah,
so so I've only run it in the US. The model is not good enough yet to do the inter cross-country stuff, and the reason why it isn't is that it's very stylized in the fact that there's a return to wealth that drives everything. And one of the pictures I've shown, for instance, is which I think it's very interesting, is if you look at wealth Gini for Sweden, so the earnings Gini for Sweden is very small. It's a very distributive society, but the wealth Gini is very high, almost as high as the US, right? So the point there is that, return that the multiplicative dimension is very strong and drives the very top. And so to get to the understanding what you were talking about, I need a much better model of taxation taxation of wealth, taxation of earnings, and and breaking down the R, right? A little bit along the dimension that Jose was saying. For instance, he was looking at the other side of R as not just as return, but also as the rate on borrowing. So I would need, I'd love to do that, but I have to say I'd need better models.
And do you have intragenerational inequality of earnings?
Yes, that we do.
And that's very, well, I guess pre-tax, it's not all that different between the US and others, but post-tax, it's extremely different.
Yes. I only have the US again, but yes, I agree. I think you're right that it's going to be, so the clear dimension is going to be on bequest. Yes. So the clear dimension. So in fact, I mean, even in the US, it's crucial. We're basically looking at a model where the everything happens intergenerationally, and that's where, right? So it's going to be even more so if we compare to the US and Europe. Yes.
Can I ask something, since we have so many experts on the US here? I mean, if you look at the past 30 years, 40 years in the US, the wealth share of the college educated has really eaten into the wealth shares of the less educated people. Do you have a sense of what was behind that? What are the main reasons for this over time?
My sense is that there are at least 3 factors in this. The most important probably is technological. Basically skill-biased technological change. And so we really automated almost completely the manufacturing sector. There are very few jobs left. And that was all skill-favoring technological change. The international trade added a bit. So the rise of China was a piece, but I would say a much smaller piece. And then the third was a political assault on the unions, which was very organized. Our private sector union coverage is 6.5% now. It used to be, it peaked at around 30%. Reagan started.
This is not that much different in France, Jeff. You have the public sector very organized. The numbers are like that; they're single digits.
Yeah, but in Northern Europe, it's very different.
Yeah.
And so I just think that was a third component to it. Yeah. And in general, all of the move to more advanced technologies has disfavored a high school educated worker, right. And they remain the predominant part. The share of the 25 to 34-year-olds with a bachelor's or above is about 40% now. It's gone up a little bit. There's another 10 to 15% that that have some college. There's a part that has a 2-year community college, and there still is 35% that have a high school diploma, and they have no good jobs almost anywhere.
Right. Now, what you're saying, Jeff, is very important to explain the distribution of earnings.
Yes.
Right. So the question is, as Alberto noticed, I don't know if the claim was the distribution of wealth has changed between.
It was the distribution of wealth
the distribution of wealth. Then we have to go back to Alberto's thing, where earnings, at least at the top, don't seem to matter very much. So if you're trying to explain the top, you really have to look for a change in the way people are accumulating wealth, more than just what's happening with earnings. I thought that was what Alberto's numbers showed. Yeah.
At the top, what we see is that there are huge returns on. There can be huge returns on private equity. So entrepreneurs start their businesses. Many of them fail, have very low returns, but some of them enjoy very high returns, and so they get to the top of the wealth distribution. And then they invest in, you know, pretty standard financial instruments, some of them at least. And that's enough to, you know, to keep moving away from the middle class in terms of wealth. But there are other effects.
Yeah, but I think the point that Alberto made is an important one. I'm in a couple of nonprofit boards, and you know, in one of them, you know, in the either in the finance committee or the board or both, in one of them, we have incredible access to private equity, because it's a very prestigious organization and gets very easy access to private equity. And you can see this. You can also see. I want to take a look at some college data, private college in the U.S. The top private colleges have much higher return on their investment than, you know, the bottom ones. You know, so this is a question. That's just an example, because it's much harder to do that on society. But I'm sure it also happens in society. There's a lot of opportunities that are generated by who you know, and that's why when you look at things like the average return on investment in private equity funds or the average return on investments in hedge funds, it's not that great. That's just like stacks, right? But that I was talking about. Now, in the guys who have had access continuously to the best private equity funds, they do much better. Of course, the initiators of private equity firms, they have a lot of knowledge and so on, they do incredibly well. But the fact of the matter is that I think that Alberto is talking about must go through the whole society. So it's not that somebody who is, you know, it's not like Jeff Bezos' kids are going to have to buy treasury bonds. That's not what they're going to do. They're going to have access to opportunities that normal people don't have. And they seem to have these opportunities in a situation like SPACs, in which, in fact, they're going to get much lower returns.
But do you think this is, you know, due to knowledge that these people have, or is due to the fact that, you know, if you are wealthy enough, you have easier access to that sort of information? So, you know, there are a number of deals of investment opportunities that don't transit in the standard market.
It's very hard.
My impression is that, you know, being at the top of the wealth distribution makes it easier to, you know, to belong to the circle that can participate in that kind of deals.
I have no doubt that's true.
Yeah.
I completely agree
That
with
is
that.
certainly, that's certainly
Yeah.
the case.
Yeah, it's what I said about universities. You know, Harvard or Columbia or Chicago or Princeton can get returns that small universities simply cannot. And
So,
But then is
they
it
have
like,
access.
I'd be curious, I mean, the people who have measured this, is it like really
Yeah.
scale effects that you have to have big enough investments and that allows you to, because there's the
I'm not sure it's
opposing
about
story where
absolutely.
you'd say, okay, there's
Yeah.
a limited number of highly profitable investment opportunities. You know, we have these, the thing with the VCs, right? I mean, it's like not that they have that many high potential investment opportunities. So it's kind of limited, so that there would be then a race to be there, and that would become a rent-seeking story, you know, whether you have the connections or you put in the effort to get the connections to make it to them, which would go against the scale story, right? If it's sort of more like a fixed pot.
I don't think it's really a scale story. I'm not talking about a scale story. I think it's, you know, in the case of universities, you get that confused, but people have looked. Had a student actually look at the difference just between scale, you know, thinking what you get when you get an extra $1 million versus prestige. And prestige seems to play a bigger role. And the organization where I'm on the board doesn't have a huge endowment. We have $500 million of endowment, which is money, but it's not. But we do have a lot of access because of the quality of the kind of the organization. So it's not a question of scale. Our investments are not that high, cannot be that high. Because we have limits to what we can invest that we put on individual investments, which make a lot of sense from a risk point of view. So our investments are not that large.
So we know there are studies of U.S. foundations. There is a paper by Sias and Zuckman in the QJE documenting that larger foundations earn higher average returns. And actually, with Laurent Bach and Paolo, we actually got this data and we tried to understand where the high returns were coming from. And what we found is that most of it is due to systematic risk, actually. So over the long run, the good performance of the rich foundation seems to be driven by higher systematic risk, high exposure to risk factors. So it could be a combination.
I don't know about foundations. I don't know about foundations, but how much, how much network and prestige they have, where it's proportional to size. There's some small foundations like Sloan, which is incredibly prestigious. So Sloan, I bet, can get stuff, which may be hard for much bigger foundations.
As a follow-up question here, based in Canada, there are some large public pension funds that are doing remarkably well, which means that in the end, teachers, let's say in Quebec or in Ontario, are actually doing quite well and benefiting from these enhanced investment opportunities. And by the same logic, you can have in countries such as Norway, the largest sovereign wealth fund that is doing quite well and that has redistributing aspects to the entire population. To what extent do you think these, going back to Laurent's early question, not products, but types of entities, can have a strong redistributive aspect going back to the full population?
I think the question goes back to what Laurent says. Are they getting more because they're taking more systematic risk? Anybody who took a lot of systematic risk over the last 10 years has done very well, right? Because the markets have been very good. So the question is whether they've done very well because they took more systematic risk or whether they were really better at choosing investments. And that's what Laurent was claiming, that at least for US foundations, they seem to go explain the systematic risk. When the students look at this data for US universities, systematic risk did play a small role, but it did not explain a lot of it, the prestige and the returns that the high prestige universities had.
So Jose, in some sense, you're saying that this stuff is very difficult to scale, right? Is this the point? So, the Harvard guys could run NYU's endowment and they would do better, but they don't. Or they could run Norway. Is this where you're going, or?
Yeah, I do think that there's a question of scale on those things. The opportunities appear, they are there, and it's not very different. Most vehicles, almost every vehicle, hedge fund or private equity fund, has a problem of scale. They try to do too much, they're going to put their money in stuff. Those opportunities only appear sometimes. And even people with knowledge have the same problem. And again, that depends on how much leverage they can acquire. That's the point I was trying to discuss. If you can get a lot of leverage, then scale doesn't become a problem. As your leverage gets harder to get, then scale really becomes a problem. You try to be big, you try to do something big, you're not going to find the right opportunities.
Yes, thank you. We have 10 minutes left, and perhaps it's time to maybe conclude and think about directions for future research. We have, doctoral students and young researchers on the young faculty on this live stream, so maybe that might be of interest to them. So maybe Jose, if you want to start, or.
No, I think I can start. I think that I think bringing financial markets into the discussion of inequality in a serious way is a very important question. I completely think, and I think a lot of the discussion in inequality kind of abstract from financial markets. And because of that, I think we're missing a lot of important forces on accumulation. And I think that's what, either because it's leverage or other forms of sophisticated investments that allows you that changes the picture in terms of how much inequality can generate. So I think for research questions, there's a lot of ways you can do this. There's a lot of different ways you can do that. As I said, I'm skeptical of financial instruments, and I hope to be wrong. I really love to be wrong, as financial instruments as a way of diminishing inequality. I think the things that have been discussed here, such as a different taxation system and so on, are much more direct instruments of action. And I think they are likely to be more effective. But I would love to be proved wrong. I would love to see the financial markets generating things that really help lower inequality. I just, you know, as I said, I haven't seen it yet, but they may be there. I just missed it.
Thank you. Maybe I'll turn to Florian. Florian.
Yeah, so I think it's a very interesting discussion we were having. It's exactly some of the questions I was raising at the end. You know, where does this rate of return heterogeneity come from? It's not enough to just measure the extent of it, although that we can use it to explain the dynamics that we've seen the last couple of years. But when you want to think about policy, I tried to point out, right, you know, which kind of instruments you want to use, a wealth tax, which is kind of similar to an estate tax in the way it works, or a more progressive capital gains tax. It makes a big difference where these rates of return heterogeneity come from, and whether it's real productivity in investments versus rent-seeking activities, or stuff related to your skill, to your labor effort, that would put the balance in favor of more progressive capital gains taxation rather than wealth taxation or estate taxation. So I'm coming obviously much more from the policy question, but I think public finance economists learn a lot from more direct evidence from finance researchers on these kind of topics. It was also raised, why don't we do estate taxation more? It's kind of a puzzle, and I think really the political economy for that is incredibly important. The estate tax has been backtracking, not only in the US, it has been eroding in terms of revenue, but also in European countries. And I think it's incredibly unpopular when you would think that, you know, it stands for equality of opportunity and that everybody has the same starting chances in life. It's not viewed as that by most people. It's viewed as very invasive, as a death tax. And I think it has to do, especially when you compare it to the wealth tax, with the fact that essentially if you think of it as a wealth tax that comes every 30 years rather than every year, then it really goes into the substance of the wealth. You know, it's a 30% or 40% tax rather than a 3% or 6% tax on a yearly basis. So then you get all these exceptions to make sure that businesses don't need to close when you have to pay the estate tax and so forth. And so you get into these dynamics where it doesn't become very broad-based and very easy to avoid. And I think that's one of the advantages of the wealth tax also in terms of enforcement. The estate tax is very easy to avoid and evade. You can do decades of planning to make sure you don't pay any of it. Whereas with the wealth tax, at least you have to make it plausible on a yearly basis what the evolution of your wealth is. So it gives much more data to the tax authorities. And here in Switzerland, actually, they use this. They call this the wealth development test, where they cross-check your income, the income you report against the change in the wealth from the previous year, and it has to be fitting together. You couldn't do that with the estate tax. So I do see, you know, in terms of these implementation questions, lots of interesting research potential. You know, it's in our simple model, estate tax might look very similar to a wealth tax, but in practice, I think there's important design differences that can be exploited.
Thank you, Florian, for your insights. Alberto, if you'd like to.
Yes. So I very quick, because I agree with everybody. I think we all agree, right? So the issue of, you know, breaking down financial markets, at least in the kind of model that I use, the issue of breaking down financial markets and modeling them a little bit more accurately than just R is fundamental. We've seen how important are all different kind of financial market, different aspects of the financial market matters. And the second dimension, as I was saying to Jeff, and it is what Florian is saying, I mean, the tax dimension is fundamental, it's crucial. And we know, you know, it's easy to tax earnings, relatively easy to tax earnings. And we know that it's always been very easy to tax wealth, right? So conceptually, there's a lot of dimension, like Florian is saying, that we really don't know what the effects are. And also in practice, because people run away. So from financial tax, from tax of financial assets, right? So yeah, that's the other dimension that's very important, I think, to study.
Thank you, Alberto. Jeff, would you like to do
yeah, just a few quick thoughts. First, on the financial products and financial markets. Again, my working assumption would be that it's a lot of access to deals and inside information, and the good returns going to early movers that are given privileges, whether in IPOs or through private equity. So I would try to investigate the informational differences. I don't think these are skill differences. These are who you know differences. When you know a lot of these wealthy people, you're pretty convinced it's not skill differences. So I think that there's just wealth makes wealth that we should understand better as an informational advantage. A second point I would emphasize is this crucial importance we've all been discussing about intergenerational transfers. There is discussion in the US about the difference, both political economy and operational and distributional, of estate taxes versus inheritance taxes. Now we have estate taxes, the estate pays the tax, but perhaps moving to an inheritance tax where the heir or the heirs pay the tax would be politically more feasible, less complications about breakups of businesses and so forth, and might make it easier to move. But the importance of intergenerational transfers, I think, is crucial in all of the modeling and the data, and we should understand that better. A third point I would like to see research on is how technological changes more in the real economy side, especially digitalization, artificial intelligence, robotics, and so forth, is going to change earnings distribution and wealth distribution. I think it's going to continue to be quite important. And then the final point that I've been emphasizing, I would love to see more cross-country parameterization of models, data permitting, so that we could really understand these differences. And if the wealth distribution is almost as unequal in Sweden as the US, which sounds possible, but the net of tax and transfer income distribution is much more equal, resolving that difference also, I think, would be quite interesting and important to understand. How can that be? And we could learn a lot from both empirical and theoretical work comparing these cross-country patterns.
Thank you very much, Jeff. Thank you very much to our panelists for, I think, what was a very insightful discussion. And we're going to have to stop. Michael, would you like to say a few concluding words?
I mean, I would like to thank everybody. You have thanked our speakers who did an excellent job, but I want to also thank you, Laurent, for putting this panel together. It's been a fascinating discussion, and I'm sure that lots of people will benefit from it also when it is posted on the website. So thank you very much for your thoughts and contributions.
Thank you.
Bye.
Bye-bye.
Bye-bye. Thank you.
So
Bye-bye.
See most of you tomorrow.
Ciao Alberto.
Ciao Luigi.
Ci sentiamo, c'è una barba bellissima.
Hai visto?
Complimenti. Ciao, ti mando un'email.
Bye everyone.
Bye bye.
Bye,
Thanks a lot.
Bye bye.
Ciao ciao.